Let's go inside out on Toll Brothers and home builders generally as well. Joining us now is James Demmert, founder, chief investment officer at Main Street Research. It's always lovely to see you, James. So what are your expectations when we hear from Toll Brothers later this afternoon?
Good to see you, Sam. I think Toll's probably the best of the group.
Okay.
That group has had headwinds for now a couple years because of mortgage rates. But I think, at Main Street, we like companies with great management, strong balance sheet. Toll has that great luxury market, which can really go on fire when the housing demand eventually comes back. So we expect them to probably meet expectations tonight at the close. I think they report after the close. We think they'll meet, maybe beat, because they manage those earnings so well in a slow environment.
Well, they have actually beat expectations for earnings the last 2 quarters, so let's see if they can keep it up. You mentioned that they were sort of the best of the bunch. I mean, we can see that reflected in the share performance as well, as I just mentioned, alongside DR Horton. The others have been struggling, but what has the luxury housing market been looking like? I mean, amid the whole sector performance as a whole, I mean, we've been seeing people who've been waiting on the sidelines, people who've been trying to sell their homes, actually pulling their houses off the markets as well. Are we seeing that in that sort of a top tier echelon as well?
You're still seeing it there. It's a binary trade with these housing stocks. You really need mortgage rates to come down. We're like over 6%.
Yeah.
It's kind of made the cost of housing double since mortgage rates were under 3. So in our view, for these stocks to really gain traction, and I think that Toll would lead that traction, we've got to get those mortgage rates down. So, without that, it's going to be a bit of a headwind. So we like the stock. We're not really crazy about the group. But it is an industrial stock, so there's other alternatives for investors. I do think, though, there's some signposts coming ahead for Toll and the group. One of them is what the Fed talks about, if they're really talking about raising or lowering rates more in 26. And of course, the next Fed chairman might have something to do with that. Yeah,
no, it's been interesting, actually, because I've been speaking to some of the fixed income guys over at Charles Schwab, and they've been talking about that steepening yield curve. And we keep talking about, the hope that these mortgage rates will come down, based on the benchmark. But I mean, we still haven't really seen that as far as a material impact here. Is Toll insulated from that? You say that they're more of an industrial stock in that sense. I mean, do they have other ways that they can sort of pull in revenue now?
They're probably the best managed as far as managing their earnings, and they are a one-stop shop. So you can get your mortgage through them, you can pick your home, lots of options, higher margins than their competitors. So I think that's why this stock's doing better than the others. But again, unless we can unleash lower mortgage rates, which really means the Fed's got to lower a lot more, I don't think you're going to see these stocks really catch fire.
Okay. What metrics should we be looking out for? Because something that I've been looking at throughout the course of the year as well is some of the incentives as far as, trying to attract home buyers to the market in what has been a tough year for some of these home builders. And there has been a concern of margins with respect to that story. Is this an issue for Toll?
Well, I think that's the issue with these companies. They have big headwinds because mortgage rates are just not where it's appetizing for someone to switch a home. So I think as an investor, you want to focus on those companies like Toll, best balance sheet, been around since 1967, so they really know how to manage through these slow periods, and I think that's why the stock's performing better than the others. But again, I think the binary reason, the way these stocks go higher, it could be in 2026, is rates really come down, mortgage rates follow, economy's strong, and maybe Kevin Hassett, our new Fed chairman, evidently can bring that momentum. So I think this stock's a value trade. It's 9 times earnings.
Yeah, I was
right?
just looking at that.
It's super cheap.
Right.
So for someone who has a little bit more patience, I think you're going to be very well rewarded over the next maybe year or 2.
All markets love patience.
Time.
It is a long time, but I think patience is the key here, as you say, perhaps. Thank you so much for that, James Demmert, there, founder, chief investment officer, Main Street Research, I should say. Let's trade it now with Tom White, host of Fast Market, an example trade for us for Toll Brothers.
Yeah, stock is cheap on a valuation level, but maybe it's cheap for a reason, because you're seeing the 10-year yield, which is, what the mortgage rates are kind of based off of, more than those short-term interest rates that the Fed's kind of controlling at this point. So you got to take that into consideration with this one. And you've got the 10-year at 2.5-month highs today, nearly 4.2%. So those 30-year fixed rates aren't coming down anytime soon. So I looked at a strategy in here. They don't have weekly options in Toll Brothers. They've only got monthly options, not a lot of depth or liquidity in there, only about 96 million shares outstanding as far as their float goes. So I looked at a strategy that takes advantage of a move, need a move type strategy using the option market, but I don't care which direction it goes, whether it's higher or lower. Option market's pricing in about a plus or minus 6% move either way in the shares, just over $8 in either direction. So I looked at buying an iron condor in here, going out to that December monthly cycle, so 11 days to expiration. We're going to buy the 130 put, sell the 125 put, so you're buying a put vertical that's out of the money to the downside. Then on the call side, going to buy the 145 call, sell the 150 call, so buying the $5 wide out of the money call vertical. So on the other, in each side, you're buying an out of the money vertical. You're paying roughly about a $2 debit for it. There's your risk. $200 per spread, but you can see here from the risk profile, I need moves below the break even of 128 to the downside or above the break even of 147 to the upside. So that's what I mean. Implied volatility levels typically going into earnings pretty elevated. This one not so much. So buying this iron condor allows you to take advantage of a move to the upside or to the downside more than that one standard deviation on this trade. And the idea here is stock moves more than the 6%. Maybe it moves up to 10% with that small share float, and then you can sell this at a higher closing price. But yeah, you just don't have to pick a direction on this one, Sam. You just need a move.
We sure do. So do the British cricket team, but we won't talk about that. All right, thanks so much for that, Tom White. I'll check in with you a little bit later.